Thank you for joining us today. Chevron offers powerful tools to build wealth, but if you're here, you may be wondering, how do you use them to their full potential? Whether your goal is early retirement, family legacy, or simply peace of mind, the strategies we're talking about today and the intentional decisions you make now can help give you more flexibility later to accomplish whatever goals are top of mind. So let's dive in. My name is Andrew Calhoun, and I'm an associate wealth manager here at Willis Johnson Associates. I'm a certified financial planner, and I love working with Chevron and other energy professionals to help them build robust financial plans that optimize their benefits in a tax-efficient manner to help them achieve whatever it is they want to in their lifetime. Willis Johnson Associates is an award-winning wealth management firm. While we're based out of Houston, Texas, we help oil and gas professionals across the country and abroad with their financial planning and tax needs. Today, we'll dive into your Chevron Employee Savings Investment Plan, your 401k, talk about the Mega Backdoor Roth, the Health Savings Account, or HSA, and finish with a discussion on the long-term incentive plans Chevron offers high-level professionals. We're going to walk through a lot of strategies today, and a big theme of it is what's right for you, your goals, your taxes, your long-term picture. And that's where the biggest value lives, and it's the kind of personalized planning we do every day with Chevron professionals just like you. As always, if you have any questions, be sure to include them in the survey at the end of this webinar. Let's start with your 401k, formerly called the Employee Savings Investment Plan, or ESIP. For those age 50 and over, here's how contributions break down. You could receive up to $28,000 in Chevron's company match, which is 8% of eligible income. In 2025, that's capped at $350,000 by the IRS. So take $350,000 times 8% is how you get the $28,000 of Chevron company match. In addition to that, if you're over 50, you can contribute $31,000 to the 401k plan yourself, either pre-tax or Roth. That brings your total employee contribution to $59,000. Two common questions I get are, should I contribute pre-tax or Roth? I thought I couldn't contribute to a Roth because I'm above the income limits. Is that not true? While it's true the Roth IRA contributions phase out at higher income levels, that doesn't apply to Roth 401k contributions. Regardless of your income, you can still contribute to a Roth 401k. The real question is, should you? Here's the difference. With pre-tax contributions, your contributions are tax deductible and your investments grow tax deferred, but withdrawals are eventually taxed as ordinary income. With Roth contributions, you don't get a tax deduction, but growth and withdrawals are tax-free. So you have to ask yourself, do I want a tax break now or tax-free income later? A general rule of thumb is, if you're in a higher tax bracket today, say 32% or higher, pre-tax might make more sense than contributing to Roth. But that's definitely something to talk over with an advisor for personalized guidance. Now let's build on that. In addition to the company match and employee contribution, there's another piece, the after-tax contribution. You can contribute an additional $18,500 after tax, which brings your total potential 401k savings to about $77,500 if you're 50 and older. So what's the difference between after-tax and Roth contributions? Both are made with after-tax dollars and both grow tax deferred, but when it comes to withdrawals, after-tax contributions are tax-free, while their earnings are taxable. In contrast, Roth contributions and their earnings are both tax-free if withdrawn properly. A common issue I see is clients inadvertently contributing to the after-tax bucket without understanding the implications. For instance, if your after-tax contributions represent 25% of your total account and the other 75% is growth, you can roll the after-tax contributions to a Roth IRA tax-free. If those contributions remain in the 401k, their earnings are taxable. But if you move them to the Roth IRA, future growth is tax-free. This strategy, moving the after-tax contributions into a Roth, is what's known as a Mega Backdoor Roth. It's a powerful strategy allowed by the Chevron plan due to what's known as an in-plan conversion. As for the growth portion of your after-tax money, if you roll it directly into a Roth, you'll pay taxes now. A smarter move is to roll the growth into a traditional IRA instead. This is a tax-free rollover since you're going from pre-tax to pre-tax. That way, you defer taxes and avoid paying them in a high-income year. Watch out if you're doing either kind of rollover. While it might sound simple in theory, messing this up with a simple mistake can trigger additional taxes that minimize the value of the rollover in the first place. Maxing out the 401k in a given year using these strategies can have a major impact over time. But many times, Chevron professionals don't understand just how many other benefits they have and what those benefits can do for their financial plan. At WJA, we offer complimentary meetings where we do an in-depth assessment of your company benefits to understand what's available to you. That way, we can also determine what strategies to employ to make sure there's nothing left on the table. I also want to briefly touch on net unrealized appreciation, or NUA, which can apply if you own Chevron stock in your 401k. Often this stock sits in two sources, either common stock or the Chevron ESOP. The ESOP often has a low cost basis relative to its market value. Let's say your ESOP shares have a cost basis of $608 and a market value of $5,000. Normally, you'd be taxed on the entire $5,000 distribution, but NUA allows you to carve out the ESOP shares and move them to a taxable account. The difference between the market value and the cost basis is then taxed as a long-term capital gain rather than ordinary income. A huge potential tax savings. NUA can only be triggered at retirement or another qualifying event. So if you hold ESOP shares, it may make sense to keep them through retirement. This is a strategy that may be missed when putting together retirement plans for Chevron professionals. NUA can be a tremendous tax savings opportunity for the individuals who have it, but it also requires the employee to defer rolling the 401k out to an IRA, which seems counterintuitive to those who don't understand the nuances of Chevron's benefits. Next, let's cover the IRS 415 income limitations. This rule states that once your total compensation exceeds a certain threshold, $350,000 in 2025, neither you nor Chevron can make additional 401k contributions. So what can happen is, if you haven't reached your contribution limits before your compensation exceeds $350,000, you're cut off. For example, say you have reached that threshold in June, but you've only contributed $27,000 out of your eligible $31,000. Unfortunately, you can't contribute that remaining $4,000. The takeaway here is to time your contributions so you hit the limit before hitting the $350,000 compensation cap. Now, this ties into the Mega Backdoor Roth as well. There are two types of after-tax contributions, basic and supplemental. If you roll out basic after-tax contributions while still receiving your company match, Chevron will freeze those contributions for 3 months. That's a major loss. But if your income has already exceeded $350,000 and you're no longer receiving company contributions, that window from June to December, for example, is a perfect time to roll out after-tax basic contributions without any risk of a freeze. The bottom line is know your income and when it matches up to the 415 limits. Make sure you've maxed out the after-tax basic source before rolling it out and triggering the freeze. And be strategic with your timing. Whether we're discussing how to max out the 401k or strategies like the Mega Backdoor Roth, a big part of the conversations always come back to taxes and making planning decisions around lowering lifetime taxes. In our initial meetings, we go in depth in our discussions on strategic timing, tax optimization, and where your biggest opportunities lie. At this point, we've covered how a Chevron employee over age 50 can potentially contribute up to $77,500 to their 401k in 2025. Now let's look outside the 401k, starting with the Backdoor Roth strategy. This is different from the Mega Backdoor Roth. It involves smaller contributions. For those 50 and older, you can contribute $8,000 to a Roth via this method. You start by making a non-deductible contribution to a traditional IRA. Then you convert that money into a Roth IRA. Because it was non-deductible, the conversion is tax-free. The catch is the pro rata rule, which can complicate things if you have other pre-tax IRA balances. We have a blog post on our website that explains this in detail. Next is the Health Savings Account, or HSA. To contribute, you must be enrolled in the High Deductible Health Plan, or HDHP, not the PPO. Most PPO users are familiar with the FSA, but the HSA is to the HDHP what the FSA is to the PPO. We love the HSA because it's triple tax advantage savings. Contributions are tax deductible, investment growth is tax-free, and withdrawals are tax-free if they're used for a qualified medical expense. For 2025, the contribution limits are $4,300 for self-only coverage, but that's increased to $8,550 for family coverage. Plus, if you're 55 or older, you get an additional $1,000 catch-up per person if you're married and both qualify. By combining the 401k, Backdoor Roth, and the HSA, Chevron employees age 50 and older have the opportunity to put away $94,050 in tax-advantaged accounts. And with the Secure Act 2.0, the new Super Catch-Up contribution for ages 60 to 63 means you can contribute up to $98,800 in 2025. Altogether, we're talking about nearly $100,000 in tax-advantaged opportunities, and we still have more to go. Executing all of this properly takes planning, which is why we focus on more than just investments. In our complimentary initial meetings, our advisors can walk you through how we bring together compensation, saving strategies, tax planning, and portfolio advice into one unified plan. Let's talk about your long-term incentive plans, or LTIPs, from Chevron. For some of you, these can make up anywhere between 30 to 50% of your total compensation. LTIPs are a powerful tool for building wealth, so it's important to understand how they work and how to avoid leaving money on the table. LTIPs, or long-term incentive plans, are essentially incentives designed to encourage you to work harder and stay longer at Chevron. They typically come in three forms. There's non-qualified stock options, performance shares, or PSUs, and restricted stock units, commonly called RSUs. Ongoing LTIP grants generally begin at salary grade PSG 26 and above. Some employees at PSG 25 or 24 may also receive LTIPs at their manager's discretion. As you move up within Chevron, LTIPs become increasingly valuable, ranging anywhere between 35 to as much as 140% of your total compensation. PSUs typically make up about 50% of your total LTIP value. They used to pay out in cash, but now they pay out in Chevron stock. The number of shares you receive depends on the original grant amount and a performance modifier, which is tied to Chevron's performance compared to its peers and overall stock performance. RSUs, which are similar to PSUs, but with a different vesting schedule, also used to pay out in cash and now pay out in stock. These typically account for about 25% of your LTIP value. Finally, you have non-qualified stock options, which have always paid out in stock and can make up around 25% of the LTIP value. Historically, 75% of your LTIP value was paid in cash and 25% in stock. However, starting with grants issued in 2023, 100% of LTIPs are now paid out in stock. This shift has important tax implications and creates potential concentration risk in your portfolio. As mentioned earlier, PSUs and RSUs used to pay out in cash. And for many of you, this will still be the case for the next 3 to 5 years. When those shares vest and the cash is distributed, taxes are due in that calendar year. Non-qualified stock options are different. Taxes are due at 2 points: when exercising the options and when you sell them. This gives you more discretion in tax planning, unlike the PSUs and RSUs, where taxes are automatically due upon vesting. Another important point: when PSUs and RSUs vest and pay out in cash, Morgan Stanley typically only withholds 22% for taxes. But if you're in a higher tax bracket, say 32, 35%, or even 40%, you'll likely owe additional tax. So when vesting occurs, usually in February, you could face a tax shortfall. Unless you adjust your paycheck withholding or make estimated tax payments, you might owe money come April. Here are some key planning points to think about. These options come with leverage, which can be a powerful benefit. Understanding how leverage works can help you decide when and how to exercise these options effectively. If you're in the 35% tax bracket and Morgan Stanley is already withholding 22%, there's a 13% gap you'll need to cover, either through a paycheck withholding or estimated tax payments. With LTIPs now paying out entirely in stock, your exposure to Chevron stock will likely increase unless you are actively diversifying. You could end up with a large portion of your wealth concentrated in one company. Many people receiving PSUs and RSUs from 2018 and beyond will still get cash payouts. One common pitfall is letting that cash sit idle in your Morgan Stanley account. If you're not proactive, you might miss out on potential investment growth. What does this mean for you? When you're navigating RSUs, your 401k, investing options, and more. It's easy to feel overwhelmed, second guess your next move, or unintentionally cost yourself more in taxes. Many Chevron professionals feel unsure about their financial plan, not because they lack options, but because the decisions are complex, high stakes, and difficult to get right. If you're interested in getting personalized guidance on your financial plan, we offer complimentary initial meetings with our advisors. As we get to know you, we'll dive into your goals and get to know your family. Present a personalized financial proposal that includes a full analysis of where you're at today and where you're headed. If you like what you see, we'll set up an implementation meeting to talk about what it would look like to work together and get started. What's different about our approach? Our approach is simple. No product sales, no commissions, no hidden fees, just great advice with your best interest in mind. This is one of the most important things we want our clients to know. Not all advisors are the same. Over 85% of the industry either operates as a broker-dealer or a dual representative, meaning they can earn commissions on product sales, even when that conflicts with what's best for you. At Willis Johnson Associates, we're proud to be part of the other 12%. Only 12% of firms are structured like us, with only investment advisor representatives, meaning we minimize conflicts of interest. Other advisors, such as broker-dealers or hybrid advisors, may be incentivized to sell you annuities or products you don't need as additional revenue streams, making it difficult to know what advice is in your best interests versus theirs. We've covered a lot today. If you have questions, include them in the survey after the webinar. You can also follow us on LinkedIn or YouTube, or follow me personally for updates, insights, and upcoming events. Thank you so much for joining us today. I hope to connect with you or see you in our office soon.